no one will warn you. It's a common fact that US governors won't predict a recession even though they are almost certain that it will happen anyway, as to not become a self-fulfilling prophecy. So if you really wanna know what's going on in the economy, in the stock market, you must watch this video. It's a Wall Street Station channel. There will be many tips, many charts, and today, as we are offline, I will just turn off the chart, but everything will be as always, accurate and straight to the point. Let's get to our presentation. So is USA at risk of a recession? So we gotta look at first at leading economic index, and that's the one of indicators that are presaging possible headwinds for the economy. Take in consideration such measures as payroll employment, personal income, manufacturing trade, and sales and industrial production. So right now we are highly reverted, but starting to recoup its prior highs and going towards a much positive territory. Right now, as of lately, industrial production erased some of the losses, and it's a component that made it the strongest positive contribution to latest coincident index. The question is, can we recover this tendency? And right now, I would say that the answer is kind of pervasive. As at first, we need to really go through some hard times in order to stave off this inflationary pressure. Right now, inflation is nagging every single of us. So without a kind of a slump, without erasing this compression on prices of many goods, I would say there will be very difficult to say, at least to go through this hard times. So for here, I would say that the recession will happen, but it may be delayed in time, and I will just prove it in a moment. Another very important concept is this inverted yield curve. Right now, we are dealing with an inversion, the inversion that historically led to recession in 90% of times. So we are right now occurring with a situation where the short-term interest rates are higher than the longer-term rates. And this happens when investors are willing to accept lower yields on longer-term bonds in anticipation of weaker economic conditions and lower interest rates down the line. That's why they might expect entering possible recession on the way. So the yield curve may make a borrowing for banking more expensive compared to rates they offer on savings accounts, and this could lead to reduced lending activity. And as we do know, as we are going through lower lending activity, it would mean that the contraction will be imminent. So when investors expect economic trouble ahead, they may flock to safety for longer-term government bonds, driving up the prices and pushing down yields, and that's something what happens right now. But we also have another implication, that is a proxy funds rates. Right now, what you can find right here is this divergence and clear disconnection between effective funds rates and proxy funds rate. So it's kind of complex composure, and it calculates around 12 financial indicators such as treasury and mortgage rates and borrowing spreads. And divergence in this mapping post 2008 illustrates how the proxy funds rate reacts to changes in financial conditions due to policy actions. So right now, as it's skewed to the upside, it means that we would need to, as an economy, have some of a jolt that will possibly be observed in the next coming months. That was a macro. Right now, let's get a look a bit closer. So overall, this inflation is causing positive sentiment regarding the policy expectations, but there is a concern about the sharp decrease in a nominal output growth, and this small business survey has been a recessionary state for over a year, indicating low sales growth due to rapidly slowing inflation. And that's also the situation that aligns with past recessions and correlates with the performance of the Russell 2000 index from the past decade. So you gotta remember that small cap stocks tend to perform well when economy-wide margins are expanding, and unlike the current contraction. And of course, And during this such a difficult times, we have also many zombie companies consistent with macro backdrop. Above average percent of Russell 2000 companies are non-earners. With that being said, look at Russell 2000's non-earners at the navy line. Back in 2008, we had them at around 18%. Right now, it's corrected through 20, and right now correcting a bit, but still at the very, very difficult moment and the level that we shouldn't go through. It means that we are being pushed by merely the expectations of revenue and income, but not the real valuations. Also, what I wanted to point out is this possible bankruptcy coming out of federal debt as percentage of GDP. That's right now with rates higher by 1% will really exponentially grow in time. And why is that the problem? Because reducing government spending is very challenging, since aside from spikes and drops during wartime and times like the COVID pandemic, the size of the US government has consistently expanded, that we really are relying on this fiscal drip that is really coming out of the nowhere. So implementing any cuts will be very painful for the economy. And even though many of us are not really suffering out of the poverty, but we can find the households already depleted, the excess savings of households already depleted, and that means that we are already tightening our belts, and it means that contraction right now has taken place. And what the market is telling us then, right now the earnings season on S&P 500, we are going through major correction as we couldn't live up to expectations based on this AA driven type of a move upwards. So right now S&P 500 performance during earnings season is the one of the worst since many of months, and that's also add up to concern whether this growth is sustainable. We cannot push the valuations barely on the promises indefinitely. Normally, quarterly earnings seasons were favorable for stock prices, with rallying over 60% of the time during the last decade. Presently, concerns are rising due to the possibility that strong economic data might prompt the Federal Reserve to maintain higher interest rates, and that in a conclusion will lead to eventually even a more difficult time for lenders, and those companies need lending to perform in a better manner. And what may add up to this concern of rising interest rates even for longer, above this 5.5 percentage points, is that jobless claims and job openings. Right now, job openings are dropping alongside the jobless claims, also showing that there is not very much of a concern in the economy, as with this economy bearing with inflation and pressure, there are no, for now, the macro outlook that may just prompt the Fed to lower interest rates, and there is still likelihood of going this upwards, and the lending conditions may also have a slack moment right then. So taking all of this, there is many doom and gloom type of stuff, but you can at the end just look at the pure index. So median bear market rallies, look at this one on the blue line. However, move of October 14th of 2022 closing low is right skyrocketed, and showing that Nasdaq left historical bear market territory in late April. So it means we are dealing with a unique full bear market rally type of situation. And if you would like to kind of believe that the major indexes have this predictive power of what will come next to our world, that will be not that type of a bad stuff I have pointed out, but I'll be very, very curious of your stance on the topic, as right now we are dealing with many of the worsening, maybe not worsening, but very lowered leading indicators, however lagging as jobless claims and job openings are right now at the heavy and stable type of a position. That's why even though the odds of recession are somewhat high for now, it looks like they are postponed somewhere in the future. And just let me know, when do you think it eventually will happen? So thank you very much for today's sticking around with us, and we are getting back with the regular dose of knowledge since Monday. And have a great weekend.